It didn't happen overnight. In fact, the rise of Warren Buffett from a curious 11-year-old boy in Omaha to one of the richest men in the world is one of the most powerful examples of how simple, consistent principles, executed over time, can outperform complexity, speed, and hype. This isn't a story about sudden fortune, luck, or timing the market. It's a story about something much more accessible: discipline and compounding. Today, Buffett's net worth exceeds $150 billion. And while many point to his stock-picking genius or business acumen, the true core of his success lies in two concepts that anyone can understand and apply: compound interest and value investing. Together, they become the bedrock of his fortune, and the reason he's outperformed generation after generation of investors. The hidden power of compounding. Buffett has often referred to compounding as the eighth wonder of the world. Why? Because when understood and applied properly, compounding transforms modest investments into fortunes. Not through magic, but through time and consistency. To grasp its full power, consider this. If you invest $10,000 and earn 10% annually using simple interest, you'll earn $1,000 per year. After 10 years, you have $20,000. But with compound interest, your returns begin to earn returns. That same $10,000 reinvested annually at 10% becomes over $25,900 in 10 years, over $67,000 in 20 years, and more than $174,000 in 30 years, all without adding a single extra dollar. Now stretch that principle across a lifetime, 40, 50, even 70 years, and you'll begin to see the true reason Buffett's fortune is so massive. He started early, stayed invested, and let time amplify every decision. Starting early. Buffett's first investment. Buffett's journey began at age 11 when he bought shares of City Service for $38 each. It wasn't a big bet, and he sold the shares soon after for a small profit. But in hindsight, this moment marked the beginning of a lifelong relationship with investing and a first-hand lesson in the opportunity cost of selling too soon. Had he simply held on to those early shares for decades, the power of compounding would have multiplied his modest investment exponentially. It was a formative experience. From that point forward, Buffett began learning not only how to invest, but how to think like a long-term owner, not a trader. Learning from Benjamin Graham, the value investing framework. In his late teens and early 20s, Buffett discovered Benjamin Graham, the father of value investing and author of The Intelligent Investor. Graham's philosophy was simple but revolutionary. Stocks are not lottery tickets. They are pieces of real businesses. This shifted Buffett's mindset permanently. Instead of chasing trends or timing price movements, he began evaluating the underlying value of companies. He looked for businesses that were trading below their intrinsic value, with strong fundamentals and ideally with a margin of safety. This approach, buying great businesses at good prices and holding them for decades, became the cornerstone of Buffett's investing strategy. And it's still the reason he outperforms investors who rely on speculation. The Coca-Cola bet: patience meets profit. One of Buffett's most iconic investments is Coca-Cola. In the late 1980s, after a market crash, Coca-Cola's stock price dipped significantly. Most investors were focused on fear. Buffett focused on fundamentals. He saw a brand recognized across the globe, consistent earnings, strong cash flow, and an enduring product with almost limitless scalability. So he did what few had the courage to do. He invested over $1 billion into Coca-Cola stock. That single move has since generated more than $25 billion in returns, largely through reinvested dividends. Today, Buffett earns more each year in Coca-Cola dividends than he originally paid for shares. That is compounding in action. Real businesses producing real value over decades, while patient investors reap the rewards. Seeing opportunity in crisis. American Express. In the 1960s, American Express was hit by a devastating scandal, the infamous salad oil fraud, which involved massive financial losses. Investors fled. The stock plummeted. But Buffett, as always, looked deeper. He understood that brands build trust over decades, and they don't collapse overnight. Despite the controversy, American Express remained one of the most respected financial names in the country. Buffett saw not just the damage, but the resilience. He invested heavily, And over the years, American Express became another compounder in his portfolio, generating billions in long-term returns. This was another lesson in buying when others panic, a strategy Buffett has refined into one of his most famous quotes. Be fearful when others are greedy, and greedy when others are fearful. Navigating crises. The Bank of America play. The 2008 financial crisis was one of the darkest chapters in modern investing. Banks were collapsing. Fear was widespread, and trust in the financial system was shattered. Most investors pulled back. Buffett stepped forward. He struck a strategic deal with Bank of America, acquiring preferred shares with a 6% dividend and options to convert into common stock. As the bank recovered, those shares soared, ultimately earning Buffett tens of billions in returns. Again, it wasn't timing or luck. It was the ability to assess risk rationally while everyone else was emotional. In Part 2, we'll explore how Buffett's ability to avoid bad investments, just as much as choosing great ones, has been a silent but critical factor in his success. We'll look at his early avoidance of tech stocks, the evolution of his Apple bet, and the secret to knowing when not to act. But before we continue, ask yourself, are you giving your investments enough time to work? Or are you jumping in and out, chasing quick wins that never add up? Drop your thoughts in the comments below. And if this helped clarify the power of patience and long-term thinking, go ahead and share this video with someone who needs to hear it. You might be surprised how many people don't understand how wealth is really built. In the last section, we explored how Warren Buffett built a fortune by understanding the power of compounding and identifying undervalued businesses during times of fear. But just as important as knowing when to buy is knowing what not to buy and when to simply do nothing. Buffett's discipline isn't just about patience. It's also about restraint. He doesn't chase every trend, invest in every hot company, or try to predict short-term swings. One of the core elements of his long-term success is his ability to say no, even when everyone else is saying yes. The cost of complexity, why Buffett avoided tech for years. During the 1990s and early 2000s, the internet boom captured the imagination of the entire financial world. New tech companies were going public almost weekly. Valuations soared. Headlines celebrated the new economy. Yet Buffett sat it out. To many, this made him look outdated. Critics mocked his reluctance to buy into the digital gold rush. But Buffett stayed true to his principle. Never invest in a business you don't understand. And in truth, he didn't fully understand the long-term durability of early tech companies. Many had no profits. Others had unstable leadership. Some barely had business models at all. Rather than gamble, Buffett waited. Then the dot-com bubble burst. Billions in paper wealth evaporated almost overnight. High-flying companies disappeared. Even the survivors lost 80 to 90% of their market value. Buffett's decision to stay out of the tech frenzy proved prescient. It wasn't just about avoiding losses. It was about protecting capital for future, better opportunities. The Apple bet. When a tech company becomes a consumer brand. Years later, something changed. By 2016, Apple had become one of the most profitable companies in history. But unlike the speculative dot-com startups, Apple had real earnings, predictable cash flows, and a product ecosystem that consumers loved and trusted. Buffett had always said that a great business is one you want to own forever. He also said he liked companies with a moat, something that protected them from competition. Apple, with its global brand, customer loyalty, and software integration, fit the description. So Buffett made one of the biggest investments in his career, buying billions of dollars worth of Apple stock. It wasn't just a good decision, it was a masterstroke. That single investment has since earned Berkshire Hathaway over $100 billion in profits, making Apple the most valuable asset in the portfolio. What changed? Apple wasn't just a tech company anymore. It was a consumer business with all the ingredients Buffett looks for: durability, profitability, simplicity, and a brand moat. It was a reminder that principles are flexible, but not disposable. Buffett didn't abandon his values. He adapted them to a new reality he understood deeply: the art of saying no. Buffett has often said that investors would do better if they had a punch card with just 20 investment opportunities for life. Every time they made a trade, they'd use up one of those limited punches. Why would he suggest something like that? because it would force people to be selective. Instead of reacting emotionally or following tips, they'd stop and think carefully. Is this really the best place to put my capital? Will I regret this 5 or 10 years from now? This mental model leads to sharper decision-making. It encourages research, reflection, and clarity. And that's why Buffett doesn't just focus on finding winners. He focuses on avoiding losers. Even today, he passes on dozens of companies for everyone he buys. If the business is too complex, if the leadership is questionable, or the valuation is too high, he simply moves on. He doesn't feel pressure to act. And that's why, when he does act, it matters. Geico, patience in action. One of Buffett's most enduring investments is Geico. He first bought shares in the 1950s after recognizing its innovative direct-to-consumer insurance model, which was disrupting the traditional industry. Geico wasn't flashy. It wasn't trendy. But it had strong economics and an edge that others couldn't easily replicate. Over the decades, Buffett continued to study the company. Eventually, he bought outright. Today, Geico is one of Berkshire Hathaway's cornerstone holdings. This wasn't about quick profits. It was about watching a business evolve and committing when the timing was right. Few investors have the patience to build relationships with companies across decades. Buffett does. The most dangerous strategy: doing too much. Buffett's results are legendary. But here's something that surprises most people. He trades less than almost anyone. He doesn't watch the market all day. He doesn't react to headlines. He doesn't try to catch bottoms or call tops. Instead, he reads, thinks, waits, and then moves with conviction. Most investors fail not because they pick bad stocks, but because they can't sit still. They jump in and out. They get emotional. They try to outperform the market every week. And in doing so, they pay unnecessary fees, incur taxes, and miss the benefits of long-term compounding. Buffett avoids this trap by focusing on business fundamentals. He buys companies he'd be happy to own if the market shut down for 10 years, and then he gives them the space to grow. He's famous for saying, "The stock market is designed to transfer money from the active to the patient." He means it. Index funds. Buffett's advice for everyone else. Here's another surprising truth. Buffett doesn't believe most people should try to beat the market. Instead, he's repeatedly recommended that everyday investors simply buy and hold a low-cost S&P 500 index fund. Why? Because over time, the U.S. economy grows. And if you own a piece of the market, you benefit from that growth. It's simple, low-cost, diversified, and, if held for the long term, incredibly effective. Buffett has even said that if he were managing a small sum of money, he could earn enormous returns using his investing strategy. But for most people, simplicity beats sophistication. If Buffett himself endorses indexing for the average investor, it's not a sign of surrender. It's a sign of clarity. The truth is, you don't need to be a genius to succeed. You need discipline, time, and consistency. Learning to think, not react. More than anything else, Buffett is a teacher. He doesn't just share ideas. He shares a way of thinking. He encourages us to step back, look beyond the daily noise, and ask better questions. Does this company have a future? Would I be proud to own it? Is the price reasonable? Will this decision matter in 5 years? These are the questions that guide him. And they can guide you too, whether you're managing a $500 portfolio or $5 million. In Part 3, we'll explore Buffett's most timeless lessons. Thinking in decades, trusting your framework, and how to use emotional discipline as your greatest asset. We'll also look at the biggest misconception about investing and why most people fail to build wealth even with the right tools in hand. But before we continue, take a moment to reflect. How often do you say no to an investment? Do you have a personal filter? Or do you let the market decide for you? If this video gave you a fresh perspective, share with a friend who's always looking for the next big thing. Sometimes, the smartest move is to sit still, study longer, and wait for your moment. Warren Buffett once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." That single line captures the essence of everything he believes about wealth, investing, and life. Lasting rewards are only earned by those willing to wait. It's easy to admire Buffett's net worth or investment wins, but what truly sets him apart is his ability to think in decades. In a world obsessed with quarterly earnings, trending stocks, and economic forecasts, Buffett has mastered the art of zooming out, of focusing on what truly matters and letting the rest fade away. Decades over days. Most people make financial decisions based on what they expect to happen next week or next month. Buffett doesn't. He makes decisions based on what he believes will still make sense in 10, 20, or 30 years. When he buys a company, he doesn't ask, will this stock go up tomorrow? He asks, will this business still be thriving 10 years from now? Does it have an enduring product or service? Will customers still love and need what it offers? This long-term mindset rewires how you evaluate everything. You stop caring about market corrections and start caring about moats, margins, and management. You stop reacting to headlines and start building real conviction. And in doing so, you free yourself from the chaos that wrecks most portfolios, letting time do the heavy lifting. Buffett's wealth is often attributed to his brilliance, but what's often overlooked is his timeline. He didn't just earn high returns. He earned high returns for longer than almost anyone in history. He started investing as a child, and by the time he was 30, he was already a millionaire. But a vast majority of his wealth came after age 60, thanks to one unstoppable force: compounding over time. And that's the part most people miss. They're focused on how much they can earn, but Buffett was focused on how long he could let his capital grow. That difference, compounding early and uninterrupted, is what allowed him to turn moderate gains into astronomical wealth. It's not magic, it's math. The misconception that holds most people back. Buffett has been clear. You don't need to be a genius to be a great investor, but you do need the right temperament. And that's where most people fail. It's not lack of information, it's lack of emotional discipline. Most investors panic when the market drops, chase hype when stocks soar, constantly check their portfolio, change strategy every year. Buffett doesn't do any of that. He trusts his process. He holds through storms. He buys when prices are attractive, not when they're popular. And above all, he treats volatility as opportunity, not danger. He said many times that the best returns come when you're willing to be still while others are frantic. This mindset is rare, but it's also free. Anyone can adopt it. Buffett's advice for future investors. As Buffett prepares the next generation to carry on his legacy, his message has become simpler, not more complex. Invest in what you understand. Be consistent, not flashy. Avoid debt. Hold for the long term. Focus on real value, not hype. Don't just think like an investor. Think like a business owner. These lessons aren't only for Wall Street. They're for students, workers, families, entrepreneurs. Anyone who wants to build lasting wealth without losing their peace in the process. The true goal isn't just money. It's worth noting that for Buffett, wealth was never about luxury. He still lives in the same house he bought in the 1950s. He eats at McDonald's, reads for hours every day, and drives a modest car. Why? Because the real reward of wealth is freedom, not status. Buffett's true success isn't just measured in billions. It's measured in control over his time, the integrity of his decisions, and the peace of knowing he built something enduring. That's what we should all aim for. What you can do today. You don't need a fortune to get started. In fact, Buffett believes most people can succeed by doing just a few things consistently. Start investing as early as possible. Choose simple, low-cost index funds. Add to your portfolio regularly. Stay the course when markets drop. Let compounding work without interference. If you follow these steps, you might not become the next Warren Buffett, but you'll likely beat 90% of investors who try to outsmart the system. The truth is, the financial world makes money by making investing look hard. Buffett makes it simple. And that simplicity, combined with time, is how legacies are built. If you've made it this far, it means you're serious about growing not just your portfolio, but your mindset. Many people who return to this channel regularly forget to subscribe. Take a moment now to check if you're subscribed, and make sure you turn on notifications so you never miss another insight. The ideas we explore here aren't just educational. They're transformational. Let's keep learning, building, and investing for the long game. Together,